Do you worry that a market crash in 2026 will drain your retirement savings? The truth is, even if 2026 is an X.com crash, it doesn't have to ruin your investments or your retirement. So in this video, I'll show you why so many people say the market is bound to crash in 2026, what that actually means for you, and how you can invest confidently no matter what the year brings. To start, let me show you the warning signs that have so many retirees worried the market will crash in 2026, and if they're actually as dangerous as they seem. Take a look at this chart from NASDAQ. It tracks the valuation of the S&P 500 over time, which tells you how expensive a stock is relative to the company's profits. What stands out is this. Valuations recently hit their second highest level in 150 years. Historically, a spike like this tends to set off alarm bells. The first time valuations climbed this high was 1929, and right after, we saw the worst market crash in U.S. history, with the Dow falling 89% during the Great Depression. The next peak came in 2000, followed by the dot-com crash when the NASDAQ lost nearly 80%. So today's valuations at those same record levels, it's no surprise a lot of people are anxious, especially when the media keeps running headlines like there's no mistaking what comes next for stocks. But does this automatically mean a crash is ahead? Let's go back to 1996, when valuations had climbed to their highest point since before the Great Depression. That year, the Fed chair gave a famous warning, saying investors might be getting carried away, calling it irrational exuberance. But look at what happened to the S&P 500 in the 1990s. Right here is where the Fed chair gave his speech. In the 3 years that followed, the market didn't crash. It nearly doubled, delivering an average return of almost 26%. If you sold just because the headlines looked scary, you would have missed one of the strongest runs in history. So high valuations don't automatically signal a crash. But just because the market boomed back then, why does that matter for you and for 2026? This chart compares the recent strong returns to the run leading up to the dot-com burst. At first glance, they look almost identical, which is why so many people think a crash is coming. When you zoom in, does it really look that bad? This chart from Fidelity shows the NASDAQ gains during the dot-com era compared to today. The green line starts in 1994, when Netscape, the first major web browser, was released. The black line starts in late 2022, when ChatGPT kicked off the current AI boom. If today's AI run were to match the dot-com surge, it could go for years longer. And more importantly, when you compare the gains, the current run looks modest. But dot-com is just one example. If you're worried about a crash hurting your retirement, we need to look beyond just that one run. So to see if a drop might actually be coming, I need to show you how today's run compares to every major bull run, not just one. This visual shows every bull market since the Great Depression. The dark red bars show how long each run lasted. The orange bars show how much they gained. Here's the current run, which started in October of 2022. Right away, you could see that many of the past bull markets grew much higher than the current one, and many of them lasted far longer. And when you look at the average, it's nearly 5 years long with gains of over 170%. So not only is this run far smaller than many of the major bull markets, it's also behind the average one. So just because the last few years have been strong doesn't automatically mean we're at the top, or that 2026 has to be the next big crash. And even though this is good news, retirement lasts decades, not a few years. So if you want to make sure you don't run out of money, you have to plan for the long haul. That's why we can't stop with these short bull runs. We need to zoom out to the long-term cycles. This chart from Fidelity shows these cycles going back nearly 100 years, from major generational lows to generational peaks. On average, they last about 30 years. And if today's cycle were to follow the same pattern, it would run all the way into 2039. So whether you look at the short term or the long term, the data points to the same thing. 2026 doesn't look like the disaster you're worried about. But here's the real risk for retirees. Even when the market rises for decades, most investors never see those gains in their own accounts. And it's because of one silent mistake that derails more retirements than any market crash ever has. Let me show you what that mistake is and the simple way to avoid it. This visual compares how different investments performed over a 20-year period. The green bar is the S&P 500. It averaged over 8% per year, one of the best performing assets over that period. And all the way on the right, the orange bar is the average investor. They earned just 2.1% per year, not even enough to keep up with inflation. So even though the returns were there, why did the average person earn only a fraction of them? Well, this tells the story perfectly. When the market is rising, it feels safe, so people buy. When it dips, they try to stay patient. But when the drop keeps going and the pain becomes too uncomfortable, that's when most investors sell. And when these fear-driven decisions repeat over time, they lead to what's known as the behavior gap, the difference between what investments return and what investors actually keep. It's the pattern of buying high and selling low, and it's why so many people miss out on the returns that were right there in front of them. So the question is, how do you avoid becoming the average investor? Take the moments we looked at earlier. If you invested in the S&P 500 when the Fed chair gave his famous warning in 1996, you'd have lived through two 50% crashes, 9/11, multiple wars, a financial crisis, a pandemic, and more corrections than anyone cares to remember. But if you simply stayed invested, you'd still be up just shy of 10% per year. And even if you invested at the absolute peak in 1999, right before the dot-com crash, your long-term return would still be more than 8% per year. So why is staying invested so hard? It comes down to something called loss aversion. Research shows that losses feel about twice as painful as gains feel good. Your brain treats a drop in your portfolio like a threat. And when that fear takes over, it pushes people to step out at exactly the wrong moments. But jumping out at the wrong time could be the mistake that ruins your retirement. Let me show you what that actually costs you. This chart shows the best and worst days of the S&P 500. Everyone remembers the dot-com crash and the 2008 crisis. But here's what most people forget. Some of the strongest days in market history happened right after the biggest drops. 7 of the 10 best single days happened within just 2 weeks of the 10 worst days. And you might be thinking, how bad could it really be to miss 10 good days? Well, this shows the impact. Missing the 10 best days over the last 35 years didn't just lower returns. It cut them by more than half. And this is why staying invested matters so much. Most of the gains that make retirement possible happen in the moments that feel the worst. But here's the challenge. When you're retired, you can't just wait it out. You need a strategy that keeps you invested confidently, even when the market isn't cooperating. Let me show you 2 simple strategies to help protect your retirement and invest with confidence in 2026. Think about trying to eat healthy. If you want to stop eating cookies at night, the easiest solution isn't more discipline. It's not keeping them in the house. Retirement investing works the same way. The easiest way to avoid selling during a scary market drop isn't more willpower. It's not experiencing the big drop in the first place. But how do you do that and still stay invested? This visual compares the S&P 500 with a diversified portfolio during some of the most stressful market declines. During the dot-com crash, the S&P fell nearly 50% and didn't recover for more than 4 years. But the diversified portfolio fell only about 18% and had fully recovered in just 8 months. In the 2008 financial crisis, the S&P fell 55% and took more than 3 years to recover. The diversified portfolio dropped about 36%, but it recovered in just over a year. So instead of forcing yourself to ride out the deepest part of every downturn, staying diversified helps smooth out the experience. But even if you're diversified, your portfolio can quietly become riskier than you ever intended, unless you remember one crucial step. This chart shows 2 portfolios that both started as a simple 60-40 mix. The gold line is the allocation most people think they stay invested in, steady and diversified throughout retirement. But the blue line shows what actually happens without any maintenance. Over time, as stocks rise and fall, your portfolio quietly drifts, reaching nearly 80% in stocks after a few strong years. And here's why that drift matters for your retirement. Look at the blue line during the 2008 drop. Because that portfolio had drifted so far into stocks, the crash hit a much more aggressive portfolio, turning a downturn into a far deeper, more painful drop. That's the kind of hit that caused people to panic and sell, the same behavior that created the return gap we talked about earlier. Here's how you can prevent that drift from happening to you. When stocks go up, you sell a little bit of what's high, and when bonds fall behind, you buy a little of what's low. That brings your portfolio back to the mix you originally planned, and it keeps your risk steady over time. It's called rebalancing, and when you keep your risk steady, you keep your emotions steady, and that's what helps you stay invested and remain confident. So now you know why a 2026 crash doesn't have to threaten your retirement, and how to build a portfolio that can keep you invested, protected, and confident through whatever comes next. But even with the right investment strategy, most retirees still struggle with one thing. They're terrified of spending their money, not because they don't have it, but because of one lie that nearly every retiree believes. Watch this next. It breaks down the biggest spending myth that keeps retirees from enjoying their lives and walks you through a simple framework to help you spend with confidence.